Hey traders, welcome to a crypto market update. This video is going to be a little bit different. We're going to go over the three main reasons why we are short biased on the short term, and then we'll discuss at the end of the video why we are extremely bullish on the long-term outlook for BTC. So we got three key topics we're going to cover. In order, we're going to first talk about the minor capitulation. Yet again, we've talked about this for a while, but it does create some fundamental catalyst for our short bias. Then we'll talk about the correlations with traditional assets like the S&P and the Russel2000. For those who do not know, the S&P is the 500 largest companies within the United States, and then the Russel2000 is the small cap index, so it's more speculative with a index of smaller cap companies. They're smaller, greater price appreciation possibilities, but also greater risk. So that's what we're going to be talking about today, and then we'll dive into the price action like always. So without further ado, let's first talk about the minor capitulation. We've been talking about this for a while, but it does create a structure and a fundamental catalyst for our possible short opportunity that we're going to find ourselves in here. So first off, let's just discuss what it is yet again for those who do not know. It's basically miners giving up, and it's called the minor capitulation cycle. So in short, let's say we're at a point where mining is highly profitable. This leads to more miners joining the network, increasing the hash rate. As a result, the difficulty adjusts upwards and the margins get a little thinner, but mining is still profitable, incentivizing more miners to join. Right? Everything's good. The cycle continues until a relatively large portion of miners cannot keep up anymore. So when there are more and more miners joining a network, it gets more difficult because there is only a certain amount of Bitcoin that's going to get distributed every 10 minutes to the miners, right? Every time there's a block reward, miners get BTC for the energy, and the algorithm provides them rewards for being 100% uptime and basically helping the network. But at the end of the day, there's only a certain amount of Bitcoin that is going to get distributed within this reward system. And it's going to have in May 12th, I believe it is. We'll check it in a little bit. But this amount of BTC is not going to change. Only in the halving that it'll halve every 4 years. But with more people joining on, there's going to be more competitiveness and more competition, making it more difficult to receive those funds. So some are forced to liquidate an ever-increasing percentage of their newly mined Bitcoins, eventually depleting their treasuries. Because the difficulty increases and the amount of reward stays the same, their revenues decrease and their cost to actually keep the operation running increases. So their revenues are getting squeezed. This causes an increased supply of Bitcoin for sale on the market. They need to sell more to continue operations. At some point, they capitulate and stop mining. This means the hash rate decreases, and finally, the difficulty receives a downward reset. So when they capitulate, the inefficient miners who are unable to have the lowest production cost will not be able to continue operations, and those companies will go bust, and the reward, that single pool of BTC, that fund is now getting funneled into the most efficient miners. And this is, in my opinion, the most free form of capitalism, free markets, where if you're inefficient, you die. If you're efficient, reinvest into new technology, into ways to become a better company, more efficient, you will get rewarded at the end of the day because you're going to be resilient in difficult times, unlike we've seen in the stock market, obviously. And then to further give more detail, this is a great podcast by Pomp. He's a figurehead, a very significant individual in the cryptocurrency space. He's on a lot of talk shows, great podcast host, and he interviewed Matt, and he is a CEO of a blockchain corporation. I think it's called Blockware Solutions. Let's just look. Blockware Solutions, yeah. So they mine, they sell different mining rigs, and he's very well versed in the space, and he talks about the miner capitulation cycle, mining pressure, the BTC halving, and all that stuff, and it's 43 minutes long. It's definitely worth a listen if you are interested in the space. It will create a lot more context as to the miner capitulation cycle that I'm viewing the market as well, because obviously I do respect his views of the market, because he is very, very deep in the mining space. So before we complete it, I am now going to, let me just get this one thing here. I'm going to turn off just one of the indicators and then bring over our cost of production for one Bitcoin. So we have a couple indicators on here. First, we have the Bitcoin production cost and then the Bitcoin difficulty ribbon. The difficulty ribbon is going to be these moving average looking lines, and then the production cost is going to be the red rectangular zone that is slowly moving upwards. So let's first talk about the difficulty ribbon, and then we'll get into the production cost. Also, you can find these on TradingView, but members get a really good understanding of how these work. But yeah, you can find them on TradingView if you'd like. All right, so first off, what is this? This is basically the hash rate, and if we actually go into it, it is the Bitcoin difficulty ribbons, and it is the moving average of the difficulty of the hash, right? So then if we go to the crypto links on-chain analysis and look at the hash rate, we can see basically these moving averages represent the total hash rate. This estimated number of terahashes per second in the Bitcoin network is performing in the last 24 hours. So what these moving averages are representing is basically the hash rate, which is going to be the difficulty for miners to mine BTC. Now, if we zoom out here, we can see that there are points on the chart that have the highest moving average, which is green, intersect with the longest term moving average, which is red. And these are mining capitulation cycles where there's going to be a significant portion of miners who will not be able to be profitable mining. So they quit, which means that the hash rate decreases, and then that same single fund or that single reward pool of BTC then gets distributed and funneled into the most efficient miners. And then there's a reduced amount of sell pressure because those miners are able to continue the operation, and then the sell pressure gets lifted because the old miners who were inefficient now are just completely out of the market, leaving only the efficient miners to hold the majority of the new supply coming into the market. And if they're not selling, if they're keeping it in their treasuries, you're going to get a huge surge in buy pressure because the supply has been lifted from the market. And this is a very healthy cycle within the miners. Just like there are cycles in debt, there are cycles in seasons, there are cycles really in almost everything, and this is just one of them. And then we can see right here, we did get the miner capitulation cycle initiation, in my opinion, but what's really going to set the catalyst for this is going to be the actual halving, because the miners are now going to get half as much revenues as they were prior to the halving, which is obviously a very significant reduction in the profitability, and obviously it is going to be a challenge for them to continue operations. Only the most efficient will survive. So that's the difficulty ribbon. We'll now put in the Bitcoin production cost, which is a little bit different. So we have the top part right here, which is going to be the total cost of BTC to mine. So right now, let's say it costs around $7,900 to mine one Bitcoin in US dollars. And the total electricity cost, just the electricity cost, is going to be around $47.58, around there. Now, if we look, the average cost to mine one Bitcoin is actually higher than the current cost to mine, or the current cost of one Bitcoin. Meaning that on average, there's a lot of miners who are losing money for every Bitcoin they mine. So as if there's any level of sell pressure or sell movement coming into the market, they're going to want to sell their Bitcoin because they are holding a depreciating asset, and they need to pay for their expenses, electricity bills, employees, and all that stuff with fiat currency. And if the value of their asset is going down, they're going to have to sell more in order to pay for the same amount of stuff, basically. Electricity, fees, rents, all that. So that's basically what we're seeing right now. And we saw a very similar situation back in October 2018, where we saw the average cost to mine one Bitcoin was more than the cost of actually having one BTC. And once we saw the momentum, it accelerates the movement downwards when we're below the cost to mine one Bitcoin. And then we get a long, drawn-out consolidation. This is where the real pain occurs for the miners, and I don't think we've seen that yet. We've seen a sharp drop-off initially, but we got such a quick recovery that I think that it is going to have to test the lows again, because we can see time and time again when we're in a consolidation or a downtrend, we don't get V-shaped recoveries very often. If ever, we usually get solid foundations of supports that we're going to hold before we create our volume accumulation phase, and then we get the market phase like we can see here. This was the volume accumulation phase. We did get a series of higher lows, but we had massive sell-offs going deep into the miners' kind of pain cycle, where we're just really hitting the cost of electricity, which is kind of the base that we're hitting here. And we can see that was the base back in the 50% drop. So this is one of the reasons, is I just don't think that the miners have suffered enough pain, which is kind of awful to say. But if we look back in the previous miner capitulation cycle, it takes a while for the inefficient miners to get out of the market, so then the BTC supply can get directed and funneled to the most efficient miners, which will then alleviate a lot of the supply within the market, which will then allow for a huge bull run to occur. Right? If there's less supply getting dumped into the market, it's easier for the buyers to push the price up. Right now, there's a lot of supply in the market because there's still a lot of inefficient miners, because the hash rate has increased. We need miner capitulation to wipe out the inefficient miners, so then the only ones that are left is the most efficient miners, and they're going to hold the BTC in their treasuries, which means that there's not going to be that much sell pressure coming into the market, which will create an opportunity that will allow Bitcoin to really flourish. Now, it's not going to take, a week or even a month per se, but if we look at the weekly, this actually would overlay perfectly with our long-term weekly chart, because if we do get that last push to the downside during the halving here, we could hit these lows again, but what we're really looking for is that last capitulation downwards, and then the initiation of what is going to be possibly the biggest bull run in the cryptocurrency market, bigger than 2017. So obviously it's a speculation, but this is the outlook that we're going to have within the markets, and the mining capitulation cycle is going to overlay well with the longer term price action that we currently see in the market. So that's number one reason why we think that we're going to see a move downwards before we see the huge bull run occur. Also, quickly just looking at the weekly, we see huge decreasing buy volume coming into the market. Obviously, that's a bit of a red flag as well. Bit of a side note. The next main thing we're going to be looking at is the correlations with traditional assets like stocks. And this is temporary, but let's now go into what even is a correlation. So let's get our tab here. So we're using Pearson's correlation of coefficient. Now, basically, I'm not going to explain the entire mathematics, but what we're looking for is a positive or negative correlation. Now, it is between 0 and 1. So it can be between 0 and anywhere between 1 correlation is absolutely perfect, which means Bitcoin is 100% correlated with Bitcoin. Ethereum is, for example, 0.93. It's very highly correlated with Bitcoin. And we can see the different types of relationships between the two variables. If it's around 0.1 or negative, which is negatively correlated 0.1, it's weak or it's not too correlated. 0.3 is moderately or medium correlated. 0.5 or negative 0.5 is strong or large, and anything over 0.5 is very correlated with the two variables, or the relationship between the two variables are very correlated. Now, let's look at the correlation of Bitcoin compared to the index representing the largest the largest 500 companies in the United States, which is the S&P 500. And this is the longest chart we have. It dates all the way back to before January 2011. So basically right at the start here until the present day. And we can see it is collecting the last 90 days worth of data and finding the correlations. We can look at 180 days worth or 360 days worth. But now we're going to look at short-term correlations, and we can see that BTC is in correlation with S&P at a rate of positive 0.32, which is, if we look back here, over the moderate to medium correlation. That's something that we have to take into consideration, right? Bitcoin is way more correlated with traditional assets like the S&P, like the Russell 2000, which we can see right here. What is the Russell 2000? It is going to represent the small caps, which the S&P is representing the largest 500 companies in the United States. The Russell 2000 is representing small caps, which is more speculative, more risk on type of index, which is obviously more correlated with BTC. And the Russell 2000 is having a stat of positive 0.64 in correlation with Bitcoin. And if we look at the table here, anything over 0.5 is strong or large in terms of the relationship for the correlation. And the Russell 2000 within the first quarter of 2020 is 0.64, which is very correlated with Bitcoin. So in my opinion, if you are bearish on the stock market, you are in theory expecting Bitcoin to have a next leg down, because the only way it wouldn't is if we start seeing a huge decoupling of Bitcoin within traditional assets in terms of the correlation. Because right now we're around 0.32, and we've seen the high get up to 0.37, which is very correlated, and we're nearing it right now. If we start zooming into the chart, let's get our zoom in. We can see that we're seeing a solid increase. Let's just go to the 3-month. There we go. We're seeing solid increases in the correlation, and it does not really seem to be stopping anytime soon. And then if we even change the amount of days that we are taking into account for the correlation, so this is the last 90 days. If we do the last 180 days, the chart does change, but yet again, even within the last 180 days, we see a correlation of 0.167 or 0.17, which is not super correlated, but it's more or less a little bit moderate, not super strong or anything, but at the end of the day, we are still seeing positive correlations. Now flip it over to gold. Let's look at GLD and let's add it. We can see that Bitcoin is not correlated really at all with gold yet. If we do the 90-day, we can see that it's actually almost negatively correlated or just absolutely no correlation whatsoever. So right now, global investors are not seeing Bitcoin as a safe haven asset at all. It seems like in terms of the correlation between the two sets of price action. Now this could change, right? We could have a decoupling. We have no idea, but we have seen times where it can get up to 0.3, which if we do look back is going to be a moderate or medium positive correlation, which is what we're looking for if we are viewing Bitcoin as a potential safe haven asset that global investors are going to turn to when there is worry of inflation. So that's going to be the second major reason why we think that we're going to have a drop to the downside within the cryptocurrency markets for one last time, if not a couple. Because of, let's look at traditional assets. I know this is cryptocurrency, but we can see that this is the Russell 2000, and then the white line is going to be the SPX or the S&P 500, and they're very correlated, obviously, very, very similar in price action. And if we look back at this chart here, we can see that Bitcoin is 0.67 positively correlated with the Russell 2000 and 0.57 positively correlated with the S&P 500. So then let's overlay, not that one, let's compare, and let's just do BTC and put it on here. That, in my opinion, is pretty correlated, if you ask me, within 2020. Let's make this a little bit brighter, a little bit bigger. and I think orange is a fair color to use. So obviously, if we zoom out, it's a lot more distorted because Bitcoin's going to be a lot more volatile. But if we do it just right, kind of like here, we can see they're all pretty well correlated. And my view of the traditional markets is bearish. So I'm going to overlay my fundamentals within the global macro into the cryptocurrency markets because of the correlations. Yes, I would like to believe that Bitcoin's more correlated with gold than the S&P 500. I'd really like to believe that, but it's not what I hope and it's not my emotions. I'm looking at hard numbers that have proven to be true through research done by Binance, which in my opinion is a reputable company exchange to gather information from. So this is how I'm creating my bias for the short for Bitcoin here for the next leg down. And that's the second reason why I think that we're going to have a move to the downside. I'm going to get a little bit of coffee and then we'll go on to the last discussion and the last reason why we think we're going to have a move to the downside. And this is going to be just talking about the price action of Bitcoin, breaking down from the large time frames to the small time frames. Not really going to go over any alts, but just really diving into BTC. But first, I'm going to get a little bit of coffee. All right, so the last reason why we think we're going to get a move down is just the price action itself. So let's first talk about where we currently are in the market. Now, are we in a huge bull run? No, we just had a massive 50% dump. We haven't even recovered 100% from that, right? So you can say we're either in a downtrend or we're in a consolidation, right? You can argue we're in a consolidation. Totally, I understand that. But you can't say we're in a huge bull run because we haven't really seen any of the huge moves happen. We can see right here. If we're in a bull run, yeah, we can recover very, very quickly. We can see huge recoveries from the lows when we're in a huge bull run, but we're not. We're in at least a consolidation, if not a little bit of a downtrend. So how does the market react when going from a downtrend to a consolidation to an uptrend when we're in a macro sideways or downtrend consolidation? It's not like we get these huge recoveries that are V-shaped. It doesn't happen too often, if ever. We can look at the daily time frames, but even looking at the weekly here, just look at the major key zones where we're selling off, right? We see a huge sell-off here from the 96 all the way to the around 7K, and then we consolidated, and then we moved up from above 10K all the way down to like the 7K zone. We then consolidated and then we moved up, right? So within these dumps, we don't see huge recoveries. We see consolidation. And then another big dump was right here from 6K all the way to 32. We didn't see a huge recovery. We saw a consolidation where there was a point where there was very little movement compared to the previous price action, and these are volume accumulation zones. Right here, volume accumulation zone and volume accumulation zone. And these zones create a foundation where a support gets tested multiple times, and then you're able to validate, yes, it's not making a lower low. The sellers look like they have stopped selling, and we haven't seen that with Bitcoin yet. With Bitcoin, we've seen a massive dump, and then we saw a huge recovery where it's leaving a massive wick, and then we're seeing these higher lows and higher highs come in, and then it looks like we're weakening with the series of highs not being able to create a higher high. So it's holding a resistance, and now we're actually seeing a series of lower highs, so it's already turning to the downside in our opinion. So that's number one. And then just looking at the volume with some simple VSA on the weekly, like we already talked about, we're seeing decreasing buy volume. That's not super great to see. Normally we'd like to see increasing buy volume when we are seeing a strong move to the upside. So we're not seeing that as well. Now let's bring it to the daily chart, right? Now we understand the weekly. Let's bring it down to the daily. We could incorporate this ascending zone. Let's actually do that because we haven't yet, and it's a pretty important zone. I like to go on the log. Let's make that a little nicer to look at, and then it's from the around 1900 1890 zone. Ooh, let's just refine that all the way up to the 2018, 2019 low, and that's going to be our long-term ascending support that we currently see. Let's bring it back to the daily, and let's refine it just a little bit so we just have the candle closures there, and pretty happy with that zone. All right, so, oh, this moved. That was supposed to be like that. All right. Don't know how that moved. So let's talk about the daily here. Why do we think that we are potentially going to move to the downside? Well, we already talked about that low not being in, and we can see this low right here, this huge sell-off. We hit a low, and then we had a support hold the lows, and that's when our reversal happened. Same thing right here, low, low, low. Yes, we did dump down, but it's not like we had a massive recovery. We had a consolidation phase. Same thing, in my opinion, that we're going to see here. We tested a low right here. In my opinion, we could see another move down to test that low. We could see wicks all the way down to, yet again, the lows that we had, you know, sub 4K. I don't exactly know, but I'm just looking to make money on the next meet of the move to the downside here, and we can see that the funnel is still pushing the price downwards. If we just take this away, the funnel looks a lot more clear, and let's get that snipped down yet again. So we see a series of lower highs. This is a high, this is a lower high, this is a lower high, this is a lower high, and then we see it continue to be respected, right? Which is, in my opinion, a really good opportunity, because we see a descending zone and we see a less descending zone, and this, in my opinion, is a huge wedge that we're currently seeing, which is longer term bullish, but in the short term, I think we could see a spill that is going to test the lows, maybe come down a little bit lower. Don't exactly know, but in terms of the fundamentals, in terms of the more fundamentally driven biases, that's in confluence with the overall chart that I see. And then we see a squeeze right here happen, where you see a series of higher lows, and then you see a descending zone, and we saw the price reject once, and then now we broke our ascending zone, so we're now below it. So we broke below, and then we're retesting not only the descending zone for another level of supply, but also the previous support, which is now going to additionally add sell pressure within the market. So yes, we had a pump up. I did get stopped out on my Ethereum trade for a small loss, but my risk reward was like 13 to 1, 12 to 1. Really significantly reduced my risk, because I knew of if it does go above a certain point, I'm just going to get out because I don't have an edge at that point. And that's exactly what happened. I'm very all right with it. But still sticking to Bitcoin, I still have a bearish bias because of the things we talked about and looking at the daily time frame. Now let's go to the 4 hour. Oops, I'm pretty happy with that, actually, where that currently is, but I did have it. The trend line's definitely moved a little bit. Let's continue to put it right here. And I had it just like so. Just as a mid-range zone before we move on further down. But let's now move on to a different time frame, probably the 4 hour. Just going to shift this sort of like that. All right. So the 4 hour still has, well, the price really looking a little bit closer at the 4 hour, but we still haven't seen a higher high form. We've been able to hold that recent high, which in my opinion is still in a downtrend, like so. And on some alts, yeah, we did spike up, and now we're testing the horizontal resistance that we had back at the start of April, but BTC still has not yet broken the recent high right here. So in my opinion, we're still in the consolidation, if not the downtrend of the descending triangle pattern. And we did see this back in the previous price action. I didn't get stopped out. My stop loss was above that high, so I'm still in the trade, not really looking to move my stop loss or anything. I think that we will have a spill back down here, and then potentially continue downward, or just continue the consolidation. But I have a bias, and I'm sticking to it. If it does break this high, I'm not going to long. I'm going to continue to just remain patient for this trade, and then we could even test this high again, maybe, potentially. I don't exactly know, but I have a trade on, and I'm just sticking with it. And this descending trend line is going to be the main thing I'm looking at. And then we see that there's a strong level of support at around $6,700, we did get a lot of sell pressure to push down, but the buyers were able to hold that and actually push the price back up above the key level, which was right here, which I was a little bit surprised about. And then on the 1 hour, we can see it a little bit more clear. It was our resistance for a while, and we're now testing it as a support, but it does look like we're still being able to hold that descending projection zone. You can see that right here with an anchor point, and then we see a wick below, or a wick above, sorry, with a candle closure below, and we see rejection, 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 and then we see just a wick touch there, and then now we're seeing the candle closures at that zone. This was my stop loss, so I'm still not taken out of the trade, and I do expect this to be some level of a volume distribution phase before we potentially get a sell move down, maybe validating this previous level and this descending zone as a nice level of support, and then we may get some consolidation, but I'm not really going to be trading that because I already have a position on BTC. But in that said, that's basically the analysis. I am looking at it at a larger perspective on the longer time frames, on the 4 hour, on the daily. I'm not day trading right now. I'm actually taking a lot less trades this month, and even previous month I took a normal amount of trades, but this month especially I haven't taken that many trades really because I've been super patient, and because of the increased volatility, I'm just soaking up as much information, as much knowledge, as much news as I possibly can really to try to understand this market, because I think what will happen is we're setting ourselves up for quite possibly the biggest bull run in cryptocurrency history. And I'm sure you've been somewhat keeping up with the news, if not really keeping up with the fundamental factors coming into play. We see that the Fed has been printing an obscene amount of money, and it's not just the United States Central Bank. It's almost every first world, developed nations central banks that's printing obscene amounts of money. Japan, Australia, China, US, the ECB. There are so many central banks that are just saying we need to print as much money as possible to help with this pandemic. And obviously, a lot of central banks don't have really much of a choice, but you are seeing a overreaction of money printing, and that's all they can do. And especially the Fed, right? We are focusing a lot of our time and energy within the United States because obviously it's a 10x in terms of the market, and it's the powerhouse of the globe in terms of the economics, and it just makes sense to keep an eye out. But it's, in my opinion, not looking good in terms of the global macro. We'll talk about it within the global macro cycle, but it just does not make sense that the stock market will have a V-shaped recovery. And if we do continue to recover, it will be a V-shaped recovery. And a lot of analysts, IMF is all saying that this is 1930s level. It's way worse than 2008. And I completely agree. We've never had an economic shutdown where it's not just one sector. This is an entire economy that is completely halted. Just in simple economic form, one man's spending is another man's income. It's not like just the airlines, tourism, restaurants, bars. Those people have homes. Those people have cars they need to pay for, mortgages they need to pay for. They're going to cut off all spending on luxury goods and things that don't really, they're not required. It's not a necessity. And that's a ripple effect through the entire economy. And we're seeing it slowly creep up within the monthly, quarterly sales, and it's just a matter of time before it gets worse. And that is what our bias is. We are short the S&P, and I have a high conviction that it will continue to go downwards because of the fundamentals, but also back testing 2001, 2008. It is extremely common to have a 51 or 61.8% retracement. 100%, it is so common. And we have to understand that. We will get into the global macro, but that is why we are short-term bears on Bitcoin. But in terms of the decoupling, I think after this next move down, Bitcoin will see a significant decoupling from traditional assets like the S&P, like the Russell 2000, because of the weakness in the dollar. Once we start seeing the dollar weaken and the CPI go up, Consumer Price Index, I think people will flood to safe haven assets like gold and silver. We're not seeing a huge attraction to silver right now, but we will start to see, in my opinion, huge speculation in the precious metal sector due to the increased attention and awareness of inflation. And I also think that Bitcoin will serve as a means of speculation in that same kind of anti-fiat basket, you could say. Because of the fixed supply, because of the only 21 million that will ever be created, and it's going to be even less because people are sending BTC to wrong addresses, they get lost, and it's going to be a lot less than 21 million that are actually going to be circulating. And also the ease of actually trading BTC. There's futures on so many different exchanges. There's a CME, there's BACT, and this allows institutions to easily enter and exit safely. And they're not going to use some small exchange. They're going to want a very, very large company like ICE, which is Intercontinental Exchange, which owns, I believe, the NASDAQ. They created BACT, and they're the ones controlling it. And obviously, with a huge conglomerate being able to partake in the cryptocurrency market, you have institutions that are able to buy and sell, which is just going to exacerbate the ups and downs, the swing highs and swing lows, in my personal opinion. But hey, we're in the game of volatility. But in the longer term time frame, looking at the weekly, looking at the monthly, if we're talking summer of 2020, so let's say July, August, and onwards, I'm super bullish on Bitcoin, because I think at that point the fundamentals of the US dollar will change, and the Fed, as Keynesian economists, absolutely hate deflation. They think deflation is the worst thing humanly possible, and they need to curb it with money printing as they are doing right now. And we're going to see, more trillions and more trillions coming into the market. But what is different this time compared to 2008 is, but in 2008 they sent money to hedge funds, to banks, and the inflation was seen in real estate prices, in the stock market, in equities. And you didn't really see inflation in everyday goods because banks don't purchase everyday goods. What you're going to see now, in my opinion, is a shift where, because you're handing fresh printed, newly just created money and giving it to individuals across the entire United States, this freshly printed money is going to be purchasing everyday goods and services. And then you will start to see the inflation of the everyday things that you're purchasing, like food, like goods and services, really. And what we're going to be looking at is the CPI, Consumer Price Index. And right now, it's relatively stable. Some countries are actually seeing deflation, where cost of goods and services are getting lower, but I think that central banks will try to push that by printing as much money as needed in order to basically create inflation. They like inflation, which is great for asset prices, but terrible for savers trying to save for retirement. And I think the overreact, it won't work like 2008, and you will start to see inflation. And once that mindset of an entire population changes, where they're going from, okay, this US dollar is basically a safe haven, I can hold on to it for a while and I can still purchase the same stuff, and they start to realize that it can purchase less and less stuff, then the velocity will start to bend, because everyone who has the US dollar will want to spend it to buy the actual goods that they want to, because they know that in a week, in a month, and a year from now, that their value is going to be substantially decreased. And once that velocity starts to bend, it's very, very difficult to turn it back. So there's going to be a capitulation point for the US dollar. It might take a while, we don't exactly know, but I think it will inevitably occur, because once the curve starts to shift, there's no going back. You can't just suddenly bend the velocity back again and just completely, get people to save and cause deflation. It's really difficult, especially when the political leaders in the monetary policy in the Fed are major Keynesians and basically think that monetary theory, printing unlimited amounts of money, will not cause inflation. But that is going to be more for the global macro. That is going to be the completion of the crypto market update. It is a little bit different today, but I'm really, I guess, putting my neck out there in some case and really trying to give valid, honest points as to why my thesis is, where my thesis is coming from, and why I believe there is going to be a dump around the halving event. And then we're going to come out of that from a volume accumulation standpoint into a huge bull market. It could take a while. We have to assess the price action, but I just don't think that we're at that point where we're able to have a long, strong bull market yet because of the correlation, because of the minor capitulation. It's just not there yet, but it is happening. Don't think I'm a perma bear. I am very, very bullish on the cryptocurrency market. I wouldn't be in this space if I didn't think so. So thank you very much for watching. Like always, this is not financial advice. This is just, think of it as a random person on the internet that's giving his reasons why he is having, a bias of, what I think I'm thinking of actually doing, because it's just a hypothesis. It's just a speculation. There's no guarantees in the markets. There never is. And I'm just trying to create the most confluence I can with my price action setups, because it's really good when you have a fundamental factor come into play that also aligns within the price action structure that you see within the market, because those are the trades that you can really size up, because you have not only the technical side, but you also have the fundamental side. Whereas if you're normally trading, if you don't have all this fundamental news coming in, it's more based on just technicals. But with all this news coming around and all the data, we can play fundamentals into it. So that's completion of the crypto market update. Thank you very much for watching. If you haven't subscribed already, we would really greatly appreciate if you subscribe to our channel. We post videos every weekday going over crypto markets as well as global macro, looking at currencies, looking at equities, indexes, commodities, cryptocurrencies. There's a lot that we do analyze, and there's probably something in there that you'll gain from, that you'll get some level of information from, which might help you trade, which might give you some perspective, or just, entertainment. We don't exactly know what this is for you, but we hope you enjoy it. So thank you very much for watching. We will go over all questions within TikTok and YouTube, but I will end off the recording there. So thank you very much for watching, everyone. Until next time, have a good one.